Microsoft's stock value ascension over the last few decades has been formidable, but has lagged the likes of Apple and some of its largest competitors over the last 12 months. Recently, though, Microsoft's exceptional performance in their cloud and AI services seems to be turning their prospects around, with Microsoft breaking new frontiers in the cloud platform and recently having the best day on the share market in 18 years. But Microsoft's rise is not just about cloud services with its Azure platform, but the company also seems to have better financial grounding than some of its rivals in the AI and cloud market, such as Apple. I'll show you side by side comparisons, and by the end of this video, you'll know where Microsoft is leading its rivals. Let's talk first about Azure, Microsoft's public cloud platform, which falls under the category of intelligent cloud and has already been well and truly up on the growth curve over the last few years. In 2025, revenue was already up 21%, the highest growth of any segment, while operating earnings was up 18%. Azure leading the growth at 34%, with the most recent quarterly results showing a massive 43% increase across the cloud platform, surpassing year to date revenue to $100 billion for the first time. With Azure's great performance and growth in other key areas, we see a huge lift to Microsoft's overall revenue with a significant increase in their services division. So let's pivot and check how the likes of Apple are faring in the services growth. Apple has recently plunged 7% shortly after they released its recent quarterly earnings. Apple reported only modest growth of around 12% year on year in their services. For Apple, this includes Apple Care, cloud services, digital content like their App Store, and Apple Card. At a total level, net sales at Apple had increased by 16%, helped by increase in product sales such as iPhones and MacBooks, while Microsoft's revenue grew by 18%. Now, that difference is quite small, Apple having 16% growth versus Microsoft at 18%, just 2% above when compared to the same quarter last year. And actually, if we look closely, Apple's gross margin growth is slightly better than Microsoft's. So, given this, what is the edge that Microsoft has? Well, Microsoft's rapid growth in Azure, Microsoft 365, and Microsoft Cloud means Microsoft is essentially setting itself up for what seems to be phenomenal future growth. Just have a look at its 10-year growth in its services segment, where it has essentially risen 10x over the last decade, whereas Apple, for example, has only grown around 5x since 2016, from around 24 billion to 109 billion at the end of 2025 within its services. In other words, Apple is more dependent on its product growth, being iPhones and MacBooks, for example, for its future growth in, say, for example, Apple Care, which, if you think about it, is dependent on product sales rather than on its own accord. For example, a consumer would not buy Apple Care if they didn't own an Apple product, whereas Microsoft services are not completely contingent on its products such as Microsoft 365, where the server and product segment, such as Microsoft Azure, is a standalone business. Now let's have a look at balance sheet strength. First, let's have a look at available cash and short-term investments. This is important for liquidity, which might be needed to pay short-term debt payments as they fall due, for example. A common measure to assess liquidity is known as current ratio. Essentially, it's the current assets divided by the current liabilities. Sounds a bit complicated, but it's simply measuring how well a company can attend to its short-term obligations. To give a real-life example, it's a bit like when a mortgage repayment is about to fall due for an average person. The ability to repay is generally based on their available cash in bank and any other assets that can easily be converted to cash to repay the loan, whereas non-current assets like a house can't simply be sold at short notice, except for extreme circumstances, to repay the loan. If we look at Microsoft, this measure sits at 1.23 times. This means there is an additional buffer to meet the short-term obligations by 23%. Coming back to our example of an average person with a mortgage, it means that they have 23% more liquid assets to make their monthly repayments within the next 12 months. Meanwhile, Apple sits at a ratio of around 1, meaning they don't quite have the same buffer. Still acceptable, but not as secure as Microsoft's position in that front. Another measure of risk is long-term debt. The more long-term debt a company holds, the higher the financing costs. Again, to draw a parallel, the more debt an average person, for example, has, the higher the interest they pay, and are more dependent on their investments to offset their interest payments, which is the whole point of debt financing, which is the hope that your return outstrips the cost of financing the debt. A common assessment measure for long-term debt is long-term debt versus net worth of the company, which is known as debt to equity ratio, and indicates how much of a company is financed through debt. If we look at Microsoft, we firstly see a huge reduction in long-term debt from 40 billion in 2025 to 31 billion in 2026, suggesting the company is achieving ample cash flow to not only meet expenses, short-term obligations, reinvestment into the business, but also pay down their debt. At 31 billion, the debt to equity ratio is about 7%, which is extraordinarily low, with the industry average sitting at around 30%. In comparison, its three major competitors, firstly Apple, has a ratio of 65%, almost 10 times higher. Even Google has a higher debt ratio at around 11%, with Amazon also trailing Microsoft at 16% debt ratio. So out of all these big hitters, Microsoft clearly is the least leveraged. This also gives investors confidence in Microsoft. Why? Having lower leverage, especially to companies within the sectors, generally means the company is better prepared to deal with future financial downturns without the need to worry too much about being highly leveraged. What Microsoft shows here is that at a net level, they are investing using the money the business generates rather than on borrowed money. So it seems the tide has turned now with Microsoft on its way to setting the stage as a leader in cloud and AI transformation, with less dependency on actual physical products and hardware, something Apple seems to be battling with at the moment with dependency on product sales such as iPhones and MacBooks. It will be interesting to see what happens over the next year or so as the competition between cloud services and AI intensifies. For now, it looks like Microsoft definitely has the edge from a growth and financial stability perspective. Thank you for watching. If you have enjoyed this video, please consider subscribing to The Experimental Economist.